Okay, so we'll say a few words about another model of market liquidity, which is complementary to the Kyle model. All right? It's going to be the Gloston and Milgram model. So in the Kyle model, trading was simultaneous. So all traders will trade at the same time, and the market maker would observe the aggregate order flow. Okay. Moreover, each trader could optimally choose the size of their order. In the Glosson and Milgram model, by contrast, trading is going to be sequential. So the market maker is going to observe each individual order. However, orders have a unique size. So all orders have the same size. The only decision made by the investor is whether to buy or to sell. But in both cases, there's going to be a market maker who is going to set prices in such a way that the market price is equal to the expected value of the asset, conditional on the information of the market maker. So in the Kyle model, the information of the market maker would be the aggregate order flow. In the Glosson and Milgram model, the information of the market maker would simply be whether a trader bought or sold the asset. So it's binary. And so an interesting lesson of this new model is that adverse selection, the fact that there will be informed trading, and so that the fact that the order is whether the investor is buying or selling the asset is going to convey some information about the asset value. So that's what I mean by adverse selection. And that's going to give rise to a bid-ask spread. The fact that when you trade in financial markets, the price at which you will be able to sell the asset would be different from the price at which you'll be able to buy the asset. And this is precisely because of asymmetric information and the fact that traders have information that market makers do not possess. Okay, so I try to understand how this works. So there's an asset with a value which is V, which is uncertain, and public information at times t is denoted by ht. There's two types of traders. Some are informed, so they have more information about V, and their private information is denoted by this information set, so it. Then there's some uninformed traders who trade because of a liquidity demand, and they will either be buying or selling depending on the value taken by this parameter. What is the sequence of events? So there's a market maker who is risk neutral and competitive, who is going to set the bid and the ask for 1 unit of the asset. So what is the bid and the ask? So the ask is the price at which the market maker is willing to sell. Okay, so that would be the price at which a trader buys. So the market maker supplies liquidity, and a trader demands liquidity here. The bid, on the contrary, is the price at which the market maker would be willing to buy whenever the trader is selling. So again, here the trader is demanding liquidity, and the market maker is supplying liquidity by taking the other side of the market. Okay. So that's the first thing. So the risk neutral market maker set the bid and the ask for 1 unit of the asset. So if you were to buy as a trader, you'll pay the ask, and if you were to sell, you would sell at the bid. So a trader who will be informed with probability alpha or uninformed with probability 1 minus alpha is going to buy or sell the unit. So if he buys, he pays the ask, and if he sells, he gets the bid. And after this trade, well, it's sequential, and so the game will be played again. And so the market maker is going to revise the bid and the ask. It's going to set a new ask and a new bid price. Okay, so from the perspective of an informed trader, so what is the expected value of an asset? We're going to denote that by ZT. So it's the expected value of the asset at time t. So it's expected value of V. So V is the fundamental value of the asset, conditional on the information set of the informed trader. which is all public information, and all private information of the informed trader here. Okay, what is the expected value of an asset for an uninformed trader with liquidity needs? So it's still going to be denoted by ZT. But now what's different is that the information set is different. It's only all public information. And there's this liquidity parameter, rho T, which might be less than 1 or greater than 1. So if rho T is greater than 1, it means that the uninformed trader values the asset a lot, so he needs to invest in the asset. If rho T is less than 1, it means that the uninformed trader doesn't value the asset as much as a trader without liquidity needs would, and that he is going to need to sell the asset. Okay. All right. So it will be the optimal trade for a trader. So you are going to buy if the expected value of the asset from your perspective, so either here or there. So if this is worth more than the ask. Okay, the ask is what you pay if you buy. You are going to sell if this expected value is less than the bid. The bid is what you receive if you sell the asset. The trader sells, he receives, he can sell at the bid. You're going to sell if you value the asset even less than that. Okay. So now how does the market maker set the bid and the ask prices? So the ask price will be the expected value of the asset, conditional on the fact that the trader is buying. Because if the trader is buying at the ask. And likewise, so the bid price will be the expected value of the asset, conditional on the seller selling, because the seller is selling at the bid. And here the idea is that, so the ask price, so AT will be larger than BT, simply because the market maker is going to take into account the fact that the trader buying or selling the asset is not completely random, right? It is going completely random in the case of an uninformed trader. And this is where the market maker is actually going to make some money by trading with uninformed trader, who trade for purposes other than information. But of course, in some cases, trading is going to be based on information. And so the market maker is going to take into account the fact that trading is informative, is potentially informative. And in particular, is going to take into account the fact that when an investor is going to buy, it might mean that the asset is worth more than when the investor is selling. So the ask price is going to be higher than the bid price. Still another way to look at it is that the ask price is going to be the expected value of the asset, conditional on the investor buying the asset, which tends to convey some positive information about the value of the asset. The bid price will be the expected value of the asset from the market maker's perspective, conditional on the investor selling the asset. And again, selling the asset tends to convey negative information, which is why the bid price is going to be lower than the ask price. And so there's no ex post regret. In any case, the market maker is happy to engage in transactions at the ask or at the bid. The ask price is a revised expectation of the security value conditional on the trader buying, and the bid price is a revised expectation of the security value conditional on the trader selling. And of course, as long as alpha is positive, so as long as there is some informed trading, there's going to be a spread between the bid and the ask, meaning that the ask is going to be larger than the bid. So whenever alpha is positive and there's going to be some informed trading, in which case the market price is going to adjust to the fact that the order is a buy order or a sell order. Okay. Moreover, so what can we learn from this model? With asymmetric information-based trading, the sequence of transaction prices, so if you take the time series of market prices, form a martingale relative to publicly available information. So let's establish this statement. So here PT is the stock price today, and this is the expected stock price in time t+1, so tomorrow. So what is the expected value of the stock price tomorrow conditional on the information today? Well, we know that by definition, the stock price tomorrow is the expected asset value conditional on the information that we have tomorrow. Okay, so if we just replace PT+1 by this expression in the conditional expectation, we have this. But now note that there is more information in HT+1. We know more tomorrow than we know today. And there's more information in HT+1 than in HT. And so here, HT corresponds to I, a smaller information set, right? And then we know that this conditional expectation is simply equal to that conditional expectation, where here, so I corresponds to HT, and G corresponds to HT+1. All right. So it means that using this equality, we can simply rewrite this like that. But what is that? That's simply the stock price today. Now, the stock price today is the expected value of the asset conditional on the expectation we have today. Okay. So again, the expected asset price next period is simply conditional on the information we have today is simply equal to the asset price today. So one implication of this martingale property is that there's no negative serial correlation. And this is not completely obvious, right? Because if you think about series of bid-ask spreads based, for example, on transaction cost, then the asset price would essentially bounce in between the bid and the ask, and so there would be a negative serial correlation, right? Whereas the theory of the bid-ask spread based on asymmetric information and based on informed trading predicts no negative serial correlation. So it's an interesting prediction that enables researchers to uniquely identify predictions of this theory and to test whether the data correspond to this theory's predictions, the martingale property, or to the predictions of other theories, for example, based on transaction cost. One last point in that in this model, market prices will be semi-strong efficient in the sense that will reflect all publicly available information.